will hear us.
No, Chelsea's going to let us in right now.
All right, so that should be us going live. So thanks to everybody who's already joined us. We're going to give it another 60 seconds or so, let the late stragglers come on. If you do have any questions or someone has had questions with you about how to join, feel free to reach out to the email addresses there on the screen and we can get you in. All right, so by my watch, it's 12:02, so we'll go ahead and get started so that we can get in all the content and quality that we needed. First of all, just thanks for joining us today. I think this is a discussion that's going to be really valuable and really informative. We know that the disruptions in the cattle market and the livestock market have been what's keeping you up tonight, or keeping you up at night. And so we're really thankful to our colleagues with American Farm Bureau for being willing to spend some time talking through those issues with us today. Before I get into their introductions, though, and some housekeeping items, I'm going to let Tiffany from New Mexico Farm Bureau welcome you as well. We're just really thankful that they were able to join with us and group with Arizona Farm Bureau to do this, and really they were responsible for setting it up. So Tiffany, thanks for letting us tag along on your parade.
Yeah, of course. I want to thank everyone for joining us again this afternoon in an attempt to continue to ensure that our membership stays engaged and educated on the trending issues. We wanted to be sure that we are providing you guys relevant content, and we're extremely grateful that John and Michael have agreed to join us this afternoon and give us some briefings on a couple of the trending topics. So thanks for spending an hour with us this afternoon, and look forward to the dialogue and discussion.
Most definitely. So speaking of John and Michael, wanted to make sure that we get their introductions in while we're at it. Before I do that, there is a question and answer feature on today's webinar. It won't be live, so we won't actually be hearing you ask the questions, but there is a chat box feature, so you should be able to access that at the top of your screen where it says show Q&A. Just add those questions as we go. I will be able to see them, and if they're related to exactly what they're talking about at the moment, I'll go ahead and interject, or if we can save them for at the end of the presentation, we'll do that too. So please feel free as we go along to let us know any questions that we can answer as we do. But with us today, we have two of American Farm Bureau's economists. The first is John Newton, the Director of Market Intelligence for American Farm Bureau, and his work in the ag sector spans over the last decade. He's represented U.S. farmers and ranchers in all kinds of capacities. He worked for the USDA as an ag economist on issues related to commodity risk management and marketing, and he also had the prestigious opportunity in 2013 to be a fellow on the United States Senate Ag Committee. And after that, he served a detail with the USDA Office of the Chief Economist, providing some policy insights for the 2014 Farm Bill. And then after that, he was on faculty at the University of Illinois and had some really groundbreaking work there, including some work on the award-winning USDA-sponsored Farm Bill Tools Project. And he was also a chief economist for the National Milk Producers Federation before he joined the American Farm Bureau as the Director of Market Intelligence in June of 2016. Also with us today, we have Michael Nephew, and he's an economist with the Farm Bureau and has been since, I think, May of 2018 is when he joined the Farm Bureau. And his issue portfolio consists of livestock and dairy market issues, Farm Bill and federal crop insurance, renewable fuels, biotech, agricultural data issues, and endangered species issues. He came to AFBF from Informa Economics Agribusiness Consulting Group, and there he was a consultant that conducted market policy and economic research and analysis in ag fields, ag risk management, transportation, and renewable energy. And he's also had some Capitol Hill experience. He had internships and placements with the Agriculture Department's Foreign Ag Service and the House Agriculture Committee. So if that does not assure you that we are in very good hands this afternoon, I don't know what does. But with that, I will stop talking and I will let Dr. Newton take it from here to give us an overview of what we're going to hear today. I think you're muted.
Can you see my slides now?
We can hear you and we can see your slides.
All right, fantastic. Well, appreciate the opportunity to join you all. I think at Farm Bureau, we've been very engaged on all the different issues that have emerged over the last 3 months with respect to the coronavirus, whether it's access to labor through the H-2A program, whether it's cattle and livestock market issues. Michael and Scott Bennett on our team have been focused and attentive, visiting with CFTC, CME, USDA, folks on Capitol Hill on these issues, whether it's the crops and dairy markets, all the challenges that we've seen emerge due to the coronavirus. We've been trying to find solutions, work with folks on Capitol Hill and the administration. President Zippy Duvall often speaks to the secretary, and so we've got an opportunity to highlight issues that farmers and ranchers are facing across the country. I think when we think back to where we were when we started the year in terms of the farm economy and farm income, we knew that farm income, net cash income was going to be a little bit lower than 2019 because we weren't expected to see another round of trade assistance. I think people were optimistic that the farm economy could improve. You think about the trade deals with USMCA, the U.S.-Japan trade agreement, the phase 1 agreement with China. We had a lot of wins under our belt on trade. We knew that we were going to have big supplies of the crops and livestock products in 2020. It was going to be a race between supply and demand, but I think farmers were optimistic that 2020 could be a better year, a light at the end of the tunnel, so to speak. And there's a good colleague of mine, a department head at Purdue. He said that light at the end of the tunnel turned out to be the light of a freight train. And coronavirus has proved to be pretty devastating to the farm economy. And where we are in mid-March, when coronavirus cases began to accelerate here in the United States, we immediately saw states issue shelter-in-place, social distancing rules. We saw restaurants, bars, movie theaters, entertainment establishments, all of those shut down. Restaurants went to delivery or limited service only. And that's been with us now for 3 months, and we've successfully flattened the curve. We do see the number of confirmed cases does tend to hit a peak and then decline, but when you look at the longer trend here, we are starting to see fewer new confirmed cases of the coronavirus. I think the concern among some is that we could see a second wave, but I have been in conversations with folks. In the event that we get a second wave, I do not think we're going to see the same type of shelter-in-place, stay-at-home orders that we saw the first time. I think given that economic performance is projected to be, yesterday I saw negative 52% change in GDP in the second quarter. So I just don't think the U.S. economy can withstand shutting down again if we get a second wave of coronaviruses. But with respect to agriculture, the first real immediate impact that we saw was in our food supply chain. And I'll add that we have a very, very efficient food supply chain in the United States, just-in-time food supply chain, but it was not prepared for the disruptions that emerged as a result of the coronavirus. More than half the food in the United States was consumed outside the home, consumed in restaurants, consumed in bars, hotels, schools. And so as those establishments were virtually shut down, you had some challenges moving that product that was destined for the restaurant to the grocery store. The packaging didn't line up with the grocery store. Plants weren't fabricated to deliver to the grocery store. And so you saw immediately we got calls from dairy producers that had to dump milk because they lost businesses. I was on the phone with Idaho Farm Bureau. We had potato growers that lost their French fry contracts and immediately saw potatoes building in inventory at a time when they're going to need to find storage space come September to put the new crop in storage. So all across the farm economy, you began to see disruptions, plowing under fruits and vegetables, all because of virtually trying to move all of that consumption through just the grocery store. When we look at the data from the Census Bureau, grocery store sales were 73 billion in March and 63 billion in April. That's up about 15% from before the coronavirus. But at food service and drinking establishments, sales were down nearly 50% from before the coronavirus. So we didn't just substitute consumption at the restaurants for consumption at the grocery store. I put another item in here just for the cotton industry. I know there's cotton there in Arizona. Clothing store sales, in-store clothing store sales dropped by nearly 90% to $2.3 billion. That had a big impact on the demand for cotton-based products. Throw into that, the slowdown in the Chinese economy, the slowdown in Southeast Asian economies and manufacturing capacity. We saw big declines in the cotton prices due to that drop-off in demand. Michael's going to cover, the livestock markets, what we've seen in cattle and hogs. But one of the other major factors that we observed and been actively working on is in the ethanol space, the renewable fuel space. With the shelter-in-place rules, gasoline demand plummeted. Take into consideration, you also had the Russia-Saudi Arabian oil war. Oil prices went negative. The May oil futures contract was negative. We haven't seen that happen in the oil industry ever. You do see it happen in I believe, electricity. Those prices do go negative from time to time. But the impact on renewable fuels, on biofuels, on ethanol made ethanol plant profitability negative. So you saw a lot of ethanol plants, idle capacity, the least efficient plants, idle capacity are shut down. And so ethanol production, and we use about 40% of the nation's corn in ethanol. Ethanol production was down as much as 40-something% a couple of weeks ago. Today it's down about 30%. But that led to sharp declines in the price for corn because the ethanol plants were not as active in the market buying corn. When we look at the impact on various commodity prices, I think the folks that have been hit the hardest with respect to the coronavirus are going to be your proteins, your dairy and protein products. We've seen corn prices fall by about 20%. Cotton prices have fallen by about 20%. Rice prices, the inner parts of the grocery store, they had a short crop last year due to the flooding and heavy rains. So a limited supply has helped to push rice prices up pretty sharply. The dairy side, we did see milk prices fall by more than 30% in mid-April, but they've rallied significantly in recent weeks behind the USDA's food purchases and distribution programs, as well as dairy cooperatives dumping milk and encouraging their producers to cut back on production. If we look at USDA's just basic world ag supply and demand estimates, we're looking at close to $60 billion in damages to just a few commodities. And when you take into consideration all the specialty crops that have been impacted, the specialty livestock that's been impacted, we see very, very significant damages to the food and agricultural sector directly related to the coronavirus. We did see the CARES Act, which was passed more than a month ago now, provide $9.5 billion to the Office of the Secretary to craft some assistance programs for farmers. We also saw $14 billion in CCC replenishment. That money will be available in July that the Secretary can use to craft additional assistance programs where needed. And so the CFAP program was crafted out of the $9.5 billion that was given to the Office of the Secretary, as well as they had an existing $6.5 billion. And so Michael will touch on the CFAP benefits for livestock, but on the crop side, most of the major field crops were eligible for CFAP assistance. The CFAP assistance for these folks is based on half of their 2019 production or what they had in inventory multiplied by these per bushel or per pound rates. For Arizona and cotton in particular, 9.5 cents per pound is eligible for cotton producers based on half their 19 production, or again, what they had in inventory on January 15th. The other thing I wanted to put it in here that we've been monitoring, and it's not related to the coronavirus, but it's incredibly important right now, is where we're at with the phase 1 agreement with China. USDA last week updated their expectations of sales to China to $13 billion this fiscal year. The phase 1 agreement to China would put their purchases at about $36.5 billion in purchases in 2020. We currently have exported about $3 billion worth of agricultural products to China through the first quarter of 2020. And all of that combined, it's going to take a Herculean effort for us to meet those phase 1 commitments to China. So I know we were very optimistic that the phase 1 agreement would help to boost demand for agricultural products. But at this point in time, I think it's going to be very, very challenging for us to meet those phase 1 commitments. A lot of the information that I provided here, as well as what Michael is going to provide in just a moment, is available on our website. So if you go to fb.org/market intel, all of this information and much more is available for free, and you could subscribe to get it delivered in your inbox. And so with that, I'll turn it back over to Michael and let him dive into some of these other issues on the livestock market.
There we go. Just want to make sure you are seeing the correct screen, or do I need to adjust that? Anybody there?
I think we want to see one screen over. We're seeing your presenter mode and not
Okay.
Yep.
And let's do that one.
There we go.
We can figure this out. All right, everybody. Like John said, I handle livestock issues for American Farm Bureau Federation. So I touch a little bit on what John did. I think he did a really good job teeing this up for me, but I'll start out by saying, John had mentioned something that triggered something in the back of my memory. So while he was talking, I frantically went and found it and then added it to it. So I just added in probably about 30 seconds ago. As he was talking about prices going negative for oil. Never happens. Sometimes happens in electricity. There actually, just for your information, is one agricultural commodity that does regularly see negative prices. And it's in the livestock sector, and that is lamb pelts. They've actually, for all of 2019 and all of 2020, pretty much have been at negative prices. And that's just something, again, that the industry is going to be severely impacted by COVID moving forward. But that's something that John said had triggered that. So I thought it'd be interesting to share at least something like that, how it impacts agriculture and specifically livestock. I know John already showed this one, but I think it's incredibly important to look at this as a way to understand and frame the discussion around livestock markets, and in particularly the meat, so beef and pork markets, as well as poultry. What happens when you see essentially, John mentioned that over half of consumer spending was through this food away from home channel. So think restaurants, institutional spending, school lunch program type stuff like that. More than half of American food dollars are spent away from home. What happens when you just shut that down and try and shift everything over to the grocery store? It's not going to be a direct one-for-one switch. There's a lot of value add that goes into the dollars being spent at restaurants, as well as some of those other food service sectors that you don't necessarily get at the retail. And again, like John said, a lot of these plants weren't necessarily tooled to be putting out product that goes well to a grocery store versus what they were actually producing was going to restaurants. I think an easy example that we try to use in the dairy sector to explain this to folks is think shredded mozzarella that is going to pizza shops. It's going to be going there in 10, 20, 30-pound bags versus your average consumer is buying shredded cheese in an 8-ounce to maybe 16-ounce little baggie in the refrigerated section at the grocery store. So not too many grocery shoppers are going to be able to take on 10, 15, 20 pounds of shredded cheese So that's just one example. Is a lot of the stuff that was going into restaurants. It's just not, you can't flip a switch and move everything automatically over to grocery stores. There's also some regulatory issues as well that USDA and FDA try to work around. Is they have labeling requirements that are always an issue. They relax some of those at the front end of this. And when we look at the impact of COVID-19 on meat markets and how that trickles down to the livestock sector, I like to break it out into two separate events in my mind. You had this initial shock to the system, which happened back in maybe mid to late March. That's when you saw grocery stores running out of meat at the meat cases, consumers sharing social media posts of empty grocery store shelves, and then it just worked up this massive panic buying that just worked its way through the system. And we were in a situation where we looked at it and said, guys, there is not a shortage of meat in this country. It's just a short-term supply chain logistical hangup because of this panic buying, and because we have all that meat that was being distributed through food service channels. We're trying to figure out how to maybe turn that back into the retail sector. So we did a lot to educate the consumer and educate folks around that there is not a meat shortage. And that initial impact, and you'll see it when I talk about the beef cutout. At the time, it was a huge spike in the beef cutout. Following that, several weeks later, you start getting into April and May, we started to see that cutout spike. And what that was much less on the demand side, so a little bit less panic buying on the consumer. We had mostly, I think, worked our way through those shocks to the system. And then you started to see the backup of animals because the COVID impact at the supply side of plants not being able to operate. You started to see capacity reduction, as well as plants just going around and just shutting down completely. That was a much bigger issue a little bit later, and then the impact of the cutout, it just skyrocketed. It was ridiculous how much it increased. So I do try to break it out into those two different events when we're looking at some of these charts and graphs I'm going to show you. So again, moving forward, looking at cash markets for fats and feeder cattle. Fed cattle, you saw that initial drop in early March. Then you see that little spike, 2020, I don't know if the mouse is visible, is the line that's dropping down. Then you saw an initial spike. That was more the panic buying at the retail level. There was a lot of folks trying to basically pull cattle through the system and be able to get more meat back on the shelves. That was that initial spike. And then following that, you start to see a dramatic decline in cattle prices even further. Now, this is one where it's a frustrating situation, but it does make economic sense when you look at processing capacity. We saw it happen with the Holcomb fire in Kansas last August. What happens when you essentially see a increase in demand for meat products, so consumers are buying more, you see the supply curve of meat shift inward, which is what happens when plants shut down. You have less processing capacity, which creates an immediate oversupply of cattle on the market needing to go to those plants. The resulting impacts, now we can't predict the magnitude very well, but we can definitely say the direction is cattle prices are going to go down because that was just a massive exogenous shock to the system that COVID caused that. There's really no way to be able to prepare for that, especially with how big these plants are, how many animals pass through them on any given day. There's a lot of economies of scale at work to make it as efficient as possible. You may have seen a little bit more of a disruption in the pork sector because it is more just-in-time delivery, to use the phrase that John had used earlier in the presentation. That just-in-time delivery system really applies very much to the pork sector because you move one batch of animals out, clean it up, next day you get a batch of animals in. It really is very quick. Hogs, you don't have as much flexibility. You don't have a lot of flexibility on cattle either, but you can, hold them on pasture a little bit longer if you got it. I know different areas of the country that's not always the case, but there is, and you can feed cattle maybe to a little bit heavier weight easier than you can hogs. Again, it really is just a huge shock to the system. Looking in the futures markets, we got to throw these up because, again, that initial decline, a little bit of a rebound, has been very volatile. We haven't seen as much of a rebound as many folks would initially think, especially with some of those out months. Now we're talking about processing capacity recovering for the most part. We're getting pretty close to operating, business as usual as best we can, but futures prices are still pretty low. A lot of that is reflecting expectations of where the economy is going to be later in the year. This COVID situation, I've talked about, shutting everybody and the impact on spending money on food at restaurants. In addition to that, a lot of these folks are out of jobs. A lot of people are seeing pay cuts. And whenever consumers are going to the grocery store during a recession, we know, using past historical perspective, that beef doesn't do very well during a recession. It is a luxury product. It costs more relative to the other animal proteins and relative to any proteins, really. And it's a luxury product, and people are willing to spend more on a steak. But whenever you're in a recession situation, consumers are looking to stretch the dollars in their pockets a little bit further. And as a result, we're looking at a little bit of a tougher road ahead on beef and cattle sector, again, as a result of the recessionary pressures that we're expecting the economy to still be in later in the year. I talked about that spike in the cutout. So I mentioned the two events. Again, I don't know if you can see the mouse, but there's that blue line, which is the 2020. Around mid-March, we see that initial jump. At the time, that was record cutout prices. It was we got a recovery where the cutout started to come back down. Then again, you saw what happened with the supply side of things, where there actually was starting to be legitimate concerns about a shortage of meat coming out of the plants. As those animals backed up, we started to see a lot of concerns. So that's what drove that up. I'll also, as a caveat, mention that just because that price is there doesn't mean all the beef at the grocery store is being priced at that level. Grocery stores, they do a lot of forward contracting. They buy a lot of this stuff 4, 6, 8 weeks ahead of time. So again, the prices that you're seeing here aren't necessarily reflective of all the meat that was moving through the plants. They weren't receiving that sky-high price for a lot of it. And that's also part of the reason it went so high, is because whenever grocery stores did run out of meat, most of the meat, again, produced by a packer on any given day is already spoken for. That means there's a smaller pool of meat on the spot market that people are competing for. So especially back in March, as retailers unexpectedly, as a result of panic buying, had to go back into the spot market and try and refill, that's a lot of competition for a relatively scarce product, not that much meat there. And that's part of what also drove it up in such a dramatic fashion with the spike that you see there. It's coming down pretty quickly, not the same, quite the same speed as it went up. We ran the numbers on this, and depending on how, if it falls as quickly as it has the last 2 days versus maybe last week, you saw it drop about $5, $6, $7 a day in the choice box beef cutout. We could be looking at pre-COVID level prices within 2-ish weeks, maybe 3, depending on how slow it goes down. And that's, again, just based on how quickly it's been falling recently. So we're definitely, we think we've turned the corner on the cutout spike that we saw. On the right side there, I have beef primal prices. This is just to illustrate that not all cuts are treated equally during COVID. Really at the beginning, we started to see your end meats, your chuck and round, start to contribute a lot more to the value of the overall cutout, especially back in March, because of, again, going back to, there's a reason I reshowed that graph that John had put up on how consumers spend their money on food, is that the cuts going to the grocery store aren't always the same as the cuts going to restaurants. So one of the most expensive cuts historically is the tenderloin. Now, whenever COVID first hit and they shut down the restaurants, that dropped significantly because it was highly exposed to the food sector. All those steakhouses that people, the average American, even if they do a lot of grilling, aren't necessarily going to be grilling fillets and tenderloins in their backyard all the time. So that's one where you saw it get hurt. But at the same time, ground beef, or the primal cuts that go into ground beef, and some of those, you know, more economical cuts that the consumer is going to buy at the grocery store, like roast, you saw those skyrocket. So their percentage share of the cutout increased dramatically. You saw, again, the primal prices kind of follow the general trajectory that we saw the overall box beef cutout follow, with just those different interactions between the end and middle meats. Now, I know when talking to cattle folks, the cutout really, it's a frustrating graph to look at, and so is the next graph. This is the live to cutout spread. Now, I am careful not to call it a margin, because the only way you're going to know packer margin is by essentially the packer telling you, and they're a private business. They're not going to do that. The best we can do is try and estimate it. And so this right here is just the cost of the output minus the cost of the input. It's byproduct value and cutout minus the cost of the steer going in. It's not taking into account things like overhead, labor. You think about with COVID, the increased marginal cost that companies are facing as they're trying to supply their workers with more PPE. They're having to institute the social distancing measures within plants and put up all these barriers between people, and hire physicians to be on staff in testing centers. That costs a lot of money. So this is not a fully accurate picture of the money going in that packers are making. One thing I also like to highlight here is it's not taking into account capacity, overall capacity utilization. So a packing plant may be very profitable running at 95, 100% capacity. If you drop that down to 50% capacity, they're having to spread a very large fixed cost from the cost of building the plant. These are $100 million investments, as well as high regulatory costs, the cost of having those FSIS inspectors on point, complying with all those regulations. It's very costly, as it should be, because it's a food safety issue, and you got to make sure that the product is food safe. But it is incredibly costly to comply with that. So if they're running at 50% capacity, they're able to spread the fixed cost over many fewer animals, and so the overall profitability of the plant is going to suffer. Now, it sounds like I'm just making up a bunch of excuses for the packers, which I'm not. I'm just trying to keep it in perspective. I know we got these gut reactions, but they were definitely making money, but maybe not as much as some folks really think that they were. I know this is primarily, I was supposed to concentrate on cattle, less on pork, so I'll keep the hog stuff fairly short, but we saw a similar reaction in the pork cutout as we did as the beef, and that's also important to mention, because if beef is the only one increasing, then you're going to see a lot of consumer substitution to things like pork and poultry. But pork also increased pretty dramatically. The thing about pork is we have recent history within the last 5-6 years where grocery stores and consumers have experienced sky-high pork prices. So even during the COVID situation, we still didn't hit record pork prices that were put into place as a result of the hog herd essentially being decimated by porcine endemic diarrhea virus, which happened back in 2014, 2013-ish. Similar story along the pork cutout primals. See that initial increase in March, drop back down, and then the supply side issues with the subsequent increase. Pork bellies just went on a roller coaster. At times, there were stories of people sending them to rendering plants because they couldn't do anything with them, because you think about how much consumers eat bacon on their bacon cheeseburgers and go have their Denny breakfasts. That food channel was shut down. So bacon is typically pretty highly exposed to the food service and restaurant sector as well. So pork belly suffered at the front end. Wild recovery a little bit later as well. So the big issue, elephant in the room throughout much of these last few months, now I mentioned we're mostly recovered, is slaughter capacity. I kind of break this issue out into two separate issues as well. There's plants shutting down, which is measurable. We have this list over here. We know that Sioux Falls plant shut down. We know that they accounted for about 4% of overall processing capacity in the country, and we're able to say, all right, here's the impact to processing capacity with these 5 plants shut down. One thing we weren't able to measure is slowdowning capacity. So as these plants instituted those social distancing measures, having workers spaced further apart, because again, this is elbow to elbow, shoulder to shoulder type work. If you're having to space them apart, your throughput through that plant is going to decrease. So there are stories, at the height of the labor issues trying to get workers into the plants, many plants we were hearing they were down to as much as 50% capacity, some running as little as 40% capacity at times on certain days. So it was a real struggle to get workers to go into the plants to be able to process these animals. And that's what's hard to measure, and that's what I think ultimately may have had a larger aggregate impact on the industry, is the slowdown in capacities, as opposed to what we were hearing directly about individual plants shutting down for 2 weeks. Since I mentioned we don't fully know how to quantify that, one proxy variable we can use is what was actual slaughter. It doesn't tell us exact capacity, but it does tell us how many animals are moving through the system as opposed to a month ago. So cattle slaughter, we've seen a pretty good rebound in both cattle and hog slaughter. It's actually been quicker than most analysts were expecting, which is a good thing for producers, because it means we're going to be able to get back to trying to work our way through the backlog in the number of animals as quickly as possible. That 38% drop is actually not year over year. It is from the height pre-COVID, before you started to see declines in slaughter back in March, down to that low in early May. So for cattle, we saw an almost 40% reduction over the course of about a month and a half or so. Again, most of that has rebounded, and we've had several weeks of consecutive increases in number of animals slaughtered. That tick back it's okay, it's normal. That was a 4-day weekend last week, or 4-day week. Yeah, 4-day weekend as well, or 3-day weekend for the Memorial Day holiday. So you see that's seasonality. We expected that drops, but on a daily basis, it was still pretty good recovery in terms of number of animals going through. So we're expecting that to continue to increase. We're hearing stories. Some of the folks are saying we could be as high as 90-95% capacity as soon as this week or next week. Hog slaughter got hit a little bit worse. Again, I mentioned it's a little bit more just-in-time delivery system. So the impact of that is felt more as it reverberates back through the supply chain. 45% drop, again, from that mid-March, late March level down to the first week of May, which was when we saw the worst of it hit the sector. Similar drawback in the holiday weekend, but not that far below 2018. We're feeling pretty confident again on pork as well, that we're going to be able to at least get pretty close to recovery. And then the challenge becomes estimating the level of depopulation in many of the animals that went through, as well as trying to work through the animals that are still alive, both hogs and cattle, that have just been backing up through the system as a result of the labor issues at the slaughter plants. Now, on to a little bit on the more policy side of things. There's been a lot of talk in the countryside, a few proposals floating around, one introduced by Senator Grassley on mandating a minimum threshold for cash trade in cattle markets. So with this, we just want to take a quick look at, okay, what's that mean? Where are cattle markets? Where are they trading now? So at a national level, we're sitting around 20 to 22%, depending on the week, in negotiated cash trade. The majority of cattle transactions in the U.S. move through this formula marketing channel. That's going to be most of your grid stuff. And basically, formula is defined as anything other than these other three. But you're basically tying the price to something else at the future. Forward contracting as well is part of that. It's got a pretty good chunk of it, and then negotiated grid's the smallest. We try to highlight that, America is a big country, lots of different regions facing a lot of different issues, and this really is a regionally different issue as well. So Texas, Oklahoma, New Mexico, as part of the USDA reported 5 area, about 80 to 90% of that is going to be in the formula pricing. Very little moves through negotiated cash trade. Again, the folks down there, that's just, again, the way they've been operating. But you look at other areas of the country, Kansas and Nebraska, and not quite the same story. So kind of similar in Kansas. The last year, it's been pretty high. Again, that 80 to 90%. Last couple of weeks, we've seen a dramatic change, again, as people are dealing with COVID, or I guess that goes back into May, not the last few weeks. But Nebraska, very different than Texas, and also very different from Kansas in that it's a pretty even mix between negotiated and formula pricing as well. So again, this is just looking at where is the country as a whole in terms of cash trade, and how does that differ between regions. John talked a little bit about CFAP. Now these numbers, the 16 billion is going to be a number that they were married to. The different industries was numbers that had leaked from the Hill. Essentially, when USDA was writing the rule, they sent over some paperwork to folks on the Hill, and this leaked out. So these were initial estimates. USDA isn't going to be held to that. They're going to make sure the money gets to the folks who need it. So some of these folks may get a little bit more, some may get a little bit less. But cattle was anticipated to get a pretty big chunk of the direct payments under the CFAP program. Now, that is, it's not moving. There we go. CFAP direct payments for livestock. It's set up in a slightly weird way that was at first pretty confusing. I know this is something where we've heard from a lot of our state farm bureaus that it's something that they want to talk to USDA about and see. They feel that maybe the CCC payment rate is fairly inadequate. But when looking at cattle, it's broken out into two different payment rates. One is the CARES Act payment rate, which applies to any cattle that you sold from January through April 15th. And John can correct me if I'm off by a day. I know there's some wiggle room. We had been talking about the exact day. So if cattle had been sold, then that's the payment rate that the individual producer gets per head on a per head basis. Anything from April, the rest of April through mid-May, what they did is they wanted to try and capture, they call it this inventory payment. So any day within that month period, basically, you select the day where you had the most number of animals on your operation, and then you get paid $33 per head for that. So you could qualify for the higher payment rate if you had sold cattle early on, then the lower payment rate essentially if you held on to them and they're part of your inventory through mid-May. Again, this is, John had mentioned that there's anticipated moving forward is that there's going to be more programs. USDA has acknowledged that the money within the CARES Act is not going to be enough to make agriculture whole, and that there's going to be more opportunities coming down the pipeline, essentially. So with that, I think I've rambled on long enough. Happy to pass control back over and move on to the next stage.
All right. Well, we appreciate that very much. Let me just send mine so that folks can see me. So we did have a question that came in during the presentation, and want to remind everybody who's watching as well, if you have questions now, please feel free to put them in the chat box, and I'll make sure that Dr. Newton and Michael can hear them. The first one is, while this has been such an outlier moment, and certainly hope this level of food supply chain disruption doesn't ever occur again, are processors looking to strategies to become more nimble and quick to shift how they process their product? And if so, how?
No, I can't. Oh, John, were you about to?
How about I'll provide some perspective and then you provide some perspective. Does that work?
That works for me.
I was on a call last week with somebody from the United Nations, and a couple things that we observed. One is this may accelerate automated workers in some of these meat packing and processing facilities, that automated technology. The second thing is I think once we get to the other side of this thing, there's not going to be a sector of the U.S. economy or economies around the world that's not going to look back, observe the blind spots, figure out if there's things that they can do to improve their supply chain. I think when you think about the role of government, should the government help to pay for idle processing capacity in the event that something like this happens? Should the government pay for the storage of commodities in the event that something like this happens? So I think after the fact, we're going to have an opportunity to review where our blind spots are, identify any policy that needs to be reviewed. I think for members across the country, your grassroots policy development process is going to be key to identify whether or not our national policy needs to be updated to help us look at the coronavirus and how we can respond to that. So I think there's going to be an opportunity to do that, but the notion that some people have said we didn't have an efficient supply chain, I think that's misguided. We had a just-in-time delivery system in the United States for food, and we never expected this type of massive demand shock. This is probably one of the largest, if not the largest, demand shock that I think our industry's seen. So with that, I'll turn it over to Michael.
Honestly, not too much to add on top of that. In terms of how it's going to look different, I think that's very difficult to really delve into. I think I agree with John. Automation is going to probably be more incorporated, but at the same time, there really is only so much automation that can happen. You're still going to have a human workforce in those plants working on this. Additionally, I would find it hard to believe that any business, not just in agriculture and processing, but across the board, is not looking at this event, figuring out A, how to emerge from it, and B, how different are they going to look after all is said and done. I think there are a few out there that really believe that the world's going to go exactly back to the way it was. Some things hopefully go back, but there's going to be a lot of things that are just different on a permanent basis moving forward. So I think businesses are absolutely going to adapt to that. Now, being able to explicitly say how, I think that's a little bit more difficult.
Well, it doesn't look like we have any additional questions to that, but did just want to say that the Market Intel website that was referenced earlier, I did put that in the chat box. It is a just fantastic resource. The things that American Farm Bureau puts out through that Market Intel platform are extremely helpful. So wanted to make sure everybody saw that there and knew that that was there. Another question did just come through for either Michael or John, and it's, do you anticipate more food preparation at home versus food service kind of moving forward after coronavirus?
I think one of the things we may see is more e-food delivery, more online grocery delivery for some people. Certainly, the extent to which people are still going to be at home. If schools don't fully reopen, then a lot of folks are still going to be working from home and preparing meals from home. So I think there's a mix. I know there's certainly a lot of people excited to get back out to the restaurants. There's pent up demand. So I think, I don't have the full answer to that question, but I think it's probably going to be a little bit of both.
I agree with everything John just said, especially the pent-up demand thing, because the second they started relaxing, at least in my neck of the woods, some of the restrictions to outdoor seating at restaurants, they packed up very quickly. So I think ultimately, it's going to be a little bit both. You're going to see a lot of folks who, don't mean to say this too much as a joke, but a lot of folks who didn't know how to cook had to be forced to learn how in the current environment, that maybe they go a little bit more that kind of spending, and we might see a little bit more of a structural shift. But I think it's going to be a combination of both.
One other thing to probably add to that is the restaurants themselves. I mean, when you open these restaurants back up, in some parts of the country, depending on the state's rules, they're not going to be at full capacity. They're going to have spaced out tables. They're not going to have as much staff, and some of these small businesses may not make it. Some of these small restaurants may not make it, and so I think that's also going to impact how much food is consumed through those channels. Given the limited restaurant capacity and potential closure of some of these restaurants.
And actually, I'm going to add on to what John just said is, not only they got to make it through this initial COVID situation, which I think there are going to be some restaurants that just don't make out after this. Additionally, even once we get to a fully, I think, post-COVID world, I bet that there is going to be continued restrictions on square footage, number of people allowed in restaurants. A lot of those restaurants, especially the high-end stuff on very razor-thin margins, relied on being able to pack those restaurants full of people. And if you lose the ability to pack it full of those people, even some of those who may have been able to make it through COVID may just decide to hang it up and say we can't operate under this current business model, depending on how long society keeps these more spaced out seating arrangements.
Switching gears just a little bit, one of the questions that came through is that since American Farm Bureau and others have requested an investigation as to whether Packers pricing is unfair, can you talk a little bit about that investigation? When do we expect results, and what's your outtake on the outcome?
So timeline is still up in the air. This is one where I can definitely assure you the folks at AFBF have been in pretty constant contact with AMS, with the Packers and Stockyards Division. Undersecretary Eyeball is very much aware of our concerns and the concerns of our membership, as well as a lot of the other organizations out there. This is one where timing is still a little bit difficult to figure out when it's going to finish, because we're still technically continuing on with the Holcomb, Kansas fire. So what USDA did was they had been investigating the Tyson fire back in August that occurred, and they had been continuing that investigation, and then COVID hit. So instead of starting a whole new investigation, they just rolled in the COVID situation, what you saw with that price disparity on one of those charts. They rolled that into the Holcomb, Kansas investigation and are continuing with that moving forward. This is one where it's not just a USDA one anymore. I forget the number of state attorneys generals penned a letter to the president asking him to get DOJ involved, which he said he would be doing. So we still don't know the outcome of the DOJ situation, but that's at least potentially two separate investigations going into this. I'll also mention even just something recently that happened today. News broke that several of the poultry companies were indicted in terms of price fixing by the DOJ. I think that broke maybe 3 or 4 hours ago. So when we think about what the potential result of an investigation like this is, I don't think it's outside the realm of possibility if on the DOJ side that something like that, even a criminal situation, could move forward. USDA would likely not be moving forward with any kind of criminal charges. It'd be much more fines to the companies for whatever instances they're able to find. John, I don't know if you have anything to add from some of our conversations.
I think the only other thing to add is that we've also been engaged with the CME. The CME has made some changes to the live cattle futures contract to try to address the market volatility. I believe the contract's only bids and asks can go in 30 minutes before the market opens. It used to be 2 hours before the market opens. So that should address some of the opening volatility in the market.
A few more questions here. One is about the nation's cold storage capacity. Does it have capacity for cold storage, and if so, how much?
That's one where I do not have the numbers right in front of me. So that's something where, maybe Chelsea, I could pull up overall capacity and shoot it over to you, and you could pass it along to whoever asked that question.
Yeah.
But the USDA, I believe they do once a year, or it might be once every 5 years. They first off, they do a monthly report where they report how much fruit, vegetable, dairy, meat, poultry is in cold storage. So we know a month-by-month availability of product in cold storage. And then on top of that, I think they do an annual, or it might be once every 3 or 5 years, review of overall capacity. So I should be able to get you those numbers.
I'd probably also add some of that stuff that's in cold storage is not, somebody already has claimed it. Somebody owns that for further distribution.
Yeah.
So it's not like there's surplus cheese just sitting in a cold storage warehouse for distribution.
Good point. Next question, is it time for regional packing plants? And regionally, can regions succeed knowing what overhead costs are?
So that's a question, you know, there has been a lot of conversation around, I guess, people thinking about the idea that a disaggregated supply chain would have resulted in less of a disruption. The answer that I would say to that is we don't really know if that's the case. It might have, it might not have. It's really hard to answer that. But smaller packing plants distributed more throughout the country. One thing we do know for sure that would come with that is increased cost in the final product moving to the consumer. Beef, we finally, you know, these last couple of years got back to seeing an increase in per capita consumption. Beef demand has been doing very well. It's already a more expensive product, and I think increasing the cost even further, especially with some of the social issues and social pressures being put on it, would just make it even more challenging for the demand side of the equation. I don't, and I'm not trying to say that, you know, that one would inherently be better than the other at addressing a COVID type disruption, but we can definitely say that the current system, because of those economies of scale, we're able to provide a more affordable product to the consumer. But I mean, it's a very fair question to look at this and say, what other system in place could have helped potentially address some of those issues?
I would add to what Michael said is we didn't get to this system overnight. The economies of scale that we've developed and the ability to supply food at low prices, because that's what the consumers demanded. If you wanted to regionalize the food supply chain, you could certainly do that. But as Michael indicated, you're going to lose the economies of scale. And so you need to be able to compete with processors that do have that scale. And so you have to have a consumer base that's likely willing to pay more for that product. And I think that's the challenge. If you can find consumers that are willing to pay more, maybe there's a premium that's put on local. I mean, we see that now with the farm to fork movement. I don't know how much that's going to continue moving forward, but there are opportunities to capture a local premium. But that's exactly what you're going to need if you try to disaggregate the supply chain. Is more premium there, and consumers, if they're willing to pay it, then that can be sustained. But if they can't, then the folks that have economies of scale are going to capture that business.
One thing sorry, I keep piggybacking off of you, John, but one thing I'll even add to that is even if they're willing to pay for it, they love the idea of local until they realize there's going to be a meat packing plant in their backyard. We saw a lot of pushback to the Walmart, Costco-owned poultry facilities going out in Nebraska. Even in these relatively rural communities, you still have a lot of folks just basically not in my backyard type mindset. So that's a whole nother challenge to overcome, to keep in mind.
Well, we're right at 1 o'clock, and it looks like those are all the questions that we had as well. So we just want to give a big thank you to John and Michael for spending this hour with us. Extremely informative, really helpful presentation, and we appreciate it very much. We're also recording the presentation, so if you have friends who didn't have the opportunity to jump on live, we'll make sure to get a link out to everybody so that we can share that. And with that, I think we just want to give one more big thank you, and we'll see you next time.
Thank you very much for having us.